knowing how all the gears turn behind the scenes, you are essentially investing blind. In this video, we're going to teach you the 63 most important stock trading and investing concepts you must know. There is also a massive catalog of premium guides that work in combination with today's lesson. We'll show you how you can get this all later in this video. Now quickly, please hit the like button as it allows for our team to continue to produce more free content on YouTube. Let's dive right into it. So what is the stock market exactly? The stock market is the global space for trading and investing. It acts as a funnel for investments to come in and profits to come out. So here's a quick history lesson. The stock market was the brainchild of the infamous Dutch East India Company. At one point, the Dutch East India Co. was the largest and most successful company in history. Achieving a worth of 8.28 trillion in the 17th century is nothing to turn your nose up at, even if they were importing such pungent spices. Dutch East India Co. wanted to continue their global expeditions in search of more exotic herbs and spices to bring back to Europe and sell at a profit. But to do this, they needed large sums of money, sums difficult for even the Dutch East India Co. to cough up. This is then when they decided to reach out to the public, selling stock in order to raise cash. This cash fueled their expeditions, which increased the profitability of the company and the value of the shares held by the initial investors. It was a win-win system, and so began a global exchange of money and assets. By 1792, 24 men, brokers and merchants alike, sat underneath one of the tallest trees in New York City and signed an agreement regarding the handling of trading, assets, and monetary exchange. They sat by the tree, which was the main place for commerce at the time, and set into action a set of standards for brokerage and trade on a little old street you may have heard of, Wall Street. Known as the Buttonwood Tree Agreement, it eventually evolved into the New York Stock Exchange, the biggest stock exchange in the world, which now trades an average of $18.9 billion a day and grows at more than 10% per year. So what are stock exchanges? Stock exchanges are marketplaces where traders, stockbrokers, and corporations buy and sell securities. In North America, you have the big ones, such as the New York Stock Exchange, the Nasdaq Stock Exchange, and the Toronto Stock Exchange. In China, you have the Shanghai Stock Exchange. In Europe, you have the Euronext. When you are researching stocks, the stock exchange is listed to the left of the ticker symbol. The Tesla stock is traded on the Nasdaq Stock Exchange. The Uber stock shows NYSE, which means it's traded on the New York Stock Exchange. The Royal Bank of Canada stock shows TSE, which means it's traded on the Toronto Stock Exchange. Moet Hennessy Louis Vuitton shows EPA, which means it's traded on the Euronext Paris Stock Exchange. The PetroChina stock shows SHA, which means it's traded on the Shanghai Stock Exchange. So what is a stock? A stock is an actual asset you invest in, and owning stock makes you a partial owner of that company. For example, if Billy buys stock in a company called Party Panda, Billy is then a partial owner of Party Panda. So what is a share? A share is the unit of measurement for the asset you have invested in. It tells us how much stock Billy owns in Party Panda. Stock price. A company's stock price is what you have to pay to obtain one share of the company's stock. $244.65 is the current price of Tesla and is what you have to pay to obtain one share. Stock price is determined by supply and demand. If you have higher demand or excess demand, price will rise to meet that demand. If you have higher supply or excess supply, price will decline to meet that supply. Price only stabilizes once there is an equilibrium between buyers and sellers, or an equilibrium between supply and demand. When you notice a rise in price, this means there are more buyers than sellers, so price rises to meet that demand. When you notice sideways price movement, this means there is an equilibrium between buyers and sellers. Then when you notice price reverse downwards, this means there is more sellers than buyers, and price falls to meet that excess supply. Ticker symbol. A ticker symbol is a unique abbreviation used to identify a publicly traded company on a stock exchange. This is usually what you type into your trading app to find the company you want to buy or sell shares in. Apple's ticker symbol is AAPL. Microsoft's ticker symbol is MSFT. Amazon's ticker symbol is AMZN. The ticker symbol is usually listed to the right of the stock exchange. So the Tesla ticker symbol is TSLA. Brokerage. Brokerages are companies that act as the middlemen in connecting buyers and sellers in order to actually complete transactions of stocks and other financial instruments. These are the apps you have on your phone or computer that you use to actually buy and sell stocks. Think companies like TD Ameritrade, Charles Schwab, and Robinhood. Margin. Margin is you borrowing money from your brokerage in order to purchase stocks through offering up securities and assets you already have in your account as collateral. Margin allows you to buy more than you otherwise could with just the cash you have in your account, meaning you can use margin to take on larger positions and achieve larger returns. But this also opens you up to possible larger losses and potentially unlimited risk.
I think I want my money back.
I have high IQ. Why do I forget what I've just read before I even finish the page?
Your brain is untrained.
Bid-ask spread. A bid price is the highest amount a buyer is willing to pay for a stock. The ask price is the lowest amount the seller is willing to accept for a stock. The difference between the bid and ask price is called the spread. Level 2 data. Level 2 data is an exchange's electronic order book that retail traders and institutions can access in order to get an in-depth look at all the bid and ask prices of a particular asset, as well as volume. This allows you to essentially see supply and demand in real time and can be used to better time trade entries and exits. Trading hours. Trading hours are the hours that the main markets are open and when you can actually buy and sell stocks and other financial assets easily due to high trading volume and high liquidity. North American stock markets, such as the New York Stock Exchange and the Nasdaq Stock Exchange and the Toronto Stock Exchange, operate from 9:30 a.m. to 4 p.m. Eastern Time. The stock market is closed on weekends and on holidays. Pre-market trading and after-hours trading. Pre-market trading is the trading activity that occurs before the regular market session opens. For North American exchanges, pre-market trading is from 4 a.m. to 9:30 a.m. Eastern Time. Traders look at the pre-market to gauge market strength and direction for the coming trading session. After-hours trading is the trading activity that occurs after the regular market session closes. For North American exchanges, after hours is from 4 p.m. to 8 p.m. Eastern Time. During pre-market and after hours, there is lower liquidity, larger quote spreads, and higher price volatility. Companies often choose to announce earnings outside of regular trading hours because this way, investors are not able to take immediate, irrational action against the stock and gives investors an opportunity to actually digest the info and act more rationally once the regular market session opens. Long position. A long position is when you buy a stock, also known as going long, expecting price to move upwards and making a profit based on its appreciation. For example, you buy a stock for $5 and it appreciates to $10. You've now made a profit of $5. This is the Upwork stock. You identify this great long trade setup here because you're at a key level with multiple touches. You're trading with the moving uptrend through the higher highs and higher lows. You have a trend line that crosses, making this an area of confluence. You have a candle color change and a long wick candle, which shows a reaction to the key area. You also have a recent reversal point close by to the left, showing that this level is valid and respected during this recent time period. Knowing all of this, you decide this is an amazing long trade opportunity and believe that price will continue upwards. You want to buy the Upwork stock and enter into a long position. Let's say you have $500 you want to invest. This candle close here, which was your long entry point, is roughly $10 per share. To figure out how many shares you can buy with $500, take your $500 and divide it by $10 per share, which gives you 50. Meaning with your $500, you can buy 50 shares of the Upwork stock at this trade setup area. Price then takes off upwards, and you notice this recent swing high reversal point here, which makes a resistance level and supply zone. You also notice a very long wick candle form, which shows a reaction to the zone. So you decide this area here would be a good time to take profit. This candle close here is roughly $14.80 a share. Remember that you have 50 shares of the Upwork stock. So you take 50 and multiply it by $14.80 per share, which gives you $740. To figure out your profit, you take the $740 and minus the $500 it originally costed you to take on the long position, and you are left with $240 in profit. Now, going in the opposite direction. Short position. A short position is when you sell a stock, also known as going short, expecting price to move downwards and making a profit based on its depreciation. For example, you want to short one share of XYZ stock that is trading at $10 a share. So you need to borrow one share of XYZ stock from your broker, and then you sell it on the open market and pocket $10 from its sale. You now owe your broker one share of XYZ stock. At a later date, XYZ's stock drops from $10 a share to $5 a share. You buy back one share of XYZ stock for $5 and give it back to your broker. You've now made $5 from this short trade, as you previously sold one share for $10, but it only costed you $5 to buy it back and settle your debt with your broker. This is the Funko Pop stock. You notice this recent swing high reversal point here, which gives you a supply zone and resistance zone. As price comes back up, you notice a wide divergence form inside of the zone, which signals a possible reversal is coming. You have a rising wedge pattern, and once it breaks below the pattern and also forms a lower low, you believe price will continue downwards. You then decide you want to open a short position. You have $1,000 you want to use to short the Funko stock. This candle here, which was your short entry point, is roughly $11.80 per share. To figure out how many shares you can short, take your $1,000 and divide it by $11.80 per share, which gives you roughly 84.75. And you would round down to 84 so that you don't go over your $1,000 limit. Now, with your $1,000, you can borrow 84 shares from your broker and sell it on the open market at $11.80 and pocket $991.20. Price then continues downwards, and you notice this recent swing low reversal point here, which makes a support level and demand zone. You decide this area here would be a good time to cover your short position. This candle close here is roughly $7.30. Remember, you owe your broker 84 shares of the Funko stock. Buying back 84 shares at the market price of $7.30 will cost you $613.20. After you settle your debt with your broker, you take the $991.20 you initially got from selling at the top and you subtract $613.20 from buying back and covering your short position at the bottom. And as a result, you've netted a profit of $378.